That is where you see they start sending random text messages to all of the person's contacts. And again, I used to tell people, you can't owe these people because they have your BVN.
Yeah.
You can't, it is looking like you are owing debt, but in reality, you can't hold them because if you have money in your account, they will auto-debit it.
You've probably heard this before. Did you know that you can borrow up to 500,000 naira on XYZ loan app with little interest and no collateral? Little interest, no collateral. Really? But who are the people complaining of borrowing 5,000 naira and that after some months, the interest has compounded to close to 50,000 naira? They are not mad. They didn't default for 1 year. They didn't run away. They just fell for the sweet, fast talk these apps used to get you in. And once you're in, they make it almost impossible to get out. You see that 5 minutes loan? It can ruin your next 5 years. From shame texts to your boss to late night panic attacks because of threats from unknown numbers. Then you begin to ask yourself, was it worth it? But by then, it's too late. You're owing more than you borrowed. You can't delete the app, and your entire contact list knows that you're a debtor. This isn't a story about money anymore. It's a story about how Africa's youth are being haunted right through their own phones. And the worst part, nobody is warning them until now. Welcome to AfriWealthWise. We ignite the spirit of financial independence and entrepreneurship in Africa's future billionaires. Whether you're building wealth from the ground up or scaling up your existing ventures, we are here to guide you towards financial freedom. If you wanted to get a loan, it was quite hard in the past. One would need to file out piles of paperwork, show dozens of documents and evidence of various things. If you didn't have a business that's registered or established, chances are no loan for you. Also, you had to drop something very important before bank could pass with your money. Collateral. People dreaded the sound of that word because if anything went wrong with the loans, they knew that the outcome wouldn't be palatable. Many people abandoned their loan application because of these collateral issues. Even after getting the collateral, if it still didn't meet up with the standards of banks, the applications ended up in the trash. Then the worst part, after all the hurdles, some bank will still require you to bring comprehensive details of people who would stand as guarantors, referees. So taking a loan in the past was such a tough war. But things soon changed. 2015 to 2018, riding on a continent-wide smartphone and mobile money boom, platforms like M-Pesa in Kenya, OPay, MoneyPoint and other microfinance banks started expanding into mobile credit services by laying the groundwork for digital borrowing. You see, by 2016 to 2018, startups such as Branch, Carbon, Fair Money, Pampi and Tala emerged in countries from Nigeria to Kenya and Egypt. These apps offered instant collateral-free loans, accessed via phone usage, spending habits and social data instead of traditional banks. Africans were easily mesmerized because when did getting loan become so easy? The real boom turned into a wildfire during and after the COVID-19 pandemic. That period, people needed fast cash, and the banks pulled back, and regulators still lagged, government reduced barriers, and investors flooded fintech markets. Finally, by 2022, fintech accounted for around 42% of all startup funding in Africa, while over half of mobile money accounts on the continent were actively being used. There were also issues of social pressure, everyday emergencies, unemployment, and the dream of quick hustle that made these apps addictive. They looked very easy on the eye, and of course, were quite flexible, but they came laden with high interest rates, rollover traps, and aggressive debt recovery. are things that nobody on this space will tell you about these loan apps. You see, those loan apps advertise 10% interest for 7 days, but there's a service fee deducted before you collect the cash. For example, one borrower asks for 100,000 naira and only received 95,000 naira. Later, she was asked to repay 204,000 naira, nearly twice the amount she'd received. Interest rates on these apps can range from 34% to over 274% in annual percentage range. Sometimes, this is payable within weeks or months, so borrowing 25,000 naira might turn into a 50,000 naira debt before you know it. Gotten the first red flag. Now let's move it. Most of these online loans are usually due in 7 to 14 days. And when you meet the deadlines, interest compounds instantly. Before you can regroup, you're borrowing new loans to pay old ones, and then the cycle spins out of control. A normal loan should be within 3 to 6 months and above and shouldn't span just days, especially with the kind of economy African countries are running that are quite unfavorable. There's also another issue with these online loans. You must have noticed that most of these apps often request access to your contacts, SMS, photos, even location data. They sometimes do this to analyze your habit and to be able to structure a loan that benefits them but keep you in debt. But if you default by one day, they start mass messaging your contact list. They also include embarrassing and fabricated stories or some intimate photos if they are able to. One former consumer protection head revealed that these online loan sharks normally employ hundreds of people whose full-time job was to harass borrowers online and offline, sometimes with deep data exploitation and shame tactics. This is even the crazier issue surrounding this topic. So people normally end up borrowing from 20 apps at once, juggling them all just to stay afloat. Many borrowers name relatives as guarantors without their consent, and those family members get harassed too. This isn't financial inclusion, it's a debt rat wheel with no end in sight. Despite regulations in places like Nigeria, where the maximum legal unsecured interest is capped at 48% annually, most apps flout this rule. Licensing is minimal, oversight is weak, and when one app gets banned, 2 more spring up with cloned UI and new names. Fintech loan apps exploded because getting started was almost free. No background checks needed, no proof of funds, no board oversight. If you had an app store listing, you were in the game. Apps like Cash, OPay, often backed by Chinese capital, set up offices with hundreds of recovery agents, calling, harassing, and sending shame messages until payments came in. Another thing to note is that these apps demand access to contacts, estimate records, location, even microphone and photos. They also use that to access credit, and when someone defaults, they weaponize that data. Also, in societies where reputation matters, shame is currencies. Apps shame borrowers publicly when their contacts get messages calling them fraudsters. Employers receive threats. Entire families feel the pressure. These tactics thrive in Kenya, Nigeria, Ghana, and survivors and consumer advocates have confirmed it's orchestrated, not accidental. Even though Nigeria took action in 2023 by passing its Data Protection Act, forming the NDPC, and mandating loan apps register and submit private policies for approval. That one loan app was even fined 50 million naira for violation. Still, enforcement struggles and credit guidelines exist, but many apps dodge them or use ghost addresses to hide. Kenya's CBK Amendment Act 2021 was meant to bring all digital lenders under regulations. But as of early 2024, only 51 out of 480 applicants were licensed. many still operate while waiting for approval. Regulation exists on paper, but enforcement is weak and fragmented. In Ghana, a lack of unified data and privacy frameworks allowed widespread harassment until the central bank began banning illegal apps in 2022 to 2023. Yes, Google also tried. They tightened the rules in early 2023. Loan apps in Nigeria and Kenya must now get local regulator approval to remain on the Play Store. Apps without licenses were removed, but thousands still operated off-store or via APKs outside these rules. The bombshell. Debt collectors earn commission per contact recruited, not per loan repaid. They pressure borrowers through shame, fear, social isolation. Borrowers often feel suicidal or depressed after repeated harassment. The emotional cost is ignored by fintech, but deeply calculated in their operating plans. It's not all doom and gloom. There are paths out of this trap. But first, you've got to shift your mind. Start with not thinking that a quick fix is free money, because every loan has a cost. Before you click borrow, ask yourself, will this help build income or deepen debt? Real freedom begins when you refuse debate. Also, communities and NGOs are stepping up. Programs like Tech Her Africa in Nigeria run financial literacy classes in indigenous languages, training women on digital tools, savings, and alternatives to loans. And Ingressive for Good provides online training for young Africans on tech and personal finance basics. Learn interest smart, demand disclosure, know before you swipe. African countries are beginning to push back, but they should do more. In Nigeria, the FCCPC and CBN recently cracked down and delisted dozens of rogue apps, enforcing caps on fees and introducing hotlines for borrower complaints. In East Africa, Kenya and Tanzania now require digital lenders to be licensed, disclose terms, and ban harassing recovery tactics. Uganda has also rolled out third lending guidelines to enforce borrower protection. Show more preference to community solution over flashy app. Monthly contributions, cooperative loans, or traditional banking loans and services such as payday and overdraft loans. Rotating savings and credit association via digital platforms like Money Fellows or Circles. Trusted groups who pool funds together without predatory rates. Organizations like Inkomoko offer small business training and responsible microfinancing with high repayment rates and clear terms. No shame tactics. Now, there are some apps that go above and beyond compliance. PalmPay in Nigeria, backed by Transom, emphasizes transparency and embeds robust KYC protocols. They partner with microfinance banks and insurers to offer fairer loans and saving options. Some digital banks like TimeBank in South Africa offer no-fee debit card and predictable saving-based credit options, not the surprise fees and threat you get from unlicensed lenders. For those chasing generational wealth with integrity and vision, AfriWealthWise is your blueprint. Subscribe, share, and be part of the movement redefining what it means to succeed in Africa.